Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Dean Fabreau, who's a banker and a vice president and manager at the San Jose main branch of the Bank of the West here in San Jose. He has worked for 42 years in the banking business. No, it must be somebody else we're talking about. Anyway, his experience includes commercial lending, and business development officer for the First National Bank in the Central Coast, and being a regional manager with major banks including Bank of America, Great Western Bank, California Federal, and Citibank. So these days bankers do move around a little bit. Dean currently is on the loan review committee for the Opportunity Fund, which is based in San Jose. And he is married and has 5 children and 8 grandchildren. Congratulations.
Thank
Grandchildren you. Are your reward for not killing your children. So, welcome.
Thank you.
Dean, thanks for being my guest today. Okay, today we're going to be talking about small business financing. And so this is an issue we think that it's important to get some information out about. Help people out that are particularly starting new businesses and so forth. They need to understand how this works. So, Dean, let's get into this. So first, what is the state of the banking industry today related to small business banking?
Well, I think it's getting back to basics and some traditional underwriting concepts. In the last few years, I think maybe many banks were a little too loose with their risk rating standards, et cetera. So I think just kind of getting back to banking 101 or lending 101.
Yes, yeah, okay. Now the newspapers say that it's hard to get financing today for a small business. Is that true?
Well, I think there's some truth to that. In the last few years with the economy, small businesses may not be generating the same revenues that they were a few years ago. So the challenge for the small business coming to apply for a loan would be, are they able to repay the loan? And
of course.
Would their cash flow support a loan that they might be requesting?
Okay. How does a bank evaluate the creditworthiness of a small business? What are the underwriting criteria?
Well, there's many standards that we would look at. We would want to obviously look at current financial statements. Are they relatively current? Aging assets, accounts receivable. Obviously the condition of the assets for liquidity in case of repayment issues down the road. Obviously we want to find out in the last couple 2 or 3 years, is the company profitable? Obviously profits dictate the healthiness of a company, so that's a main concern. And obviously the financial position of the owners. Owners become usually the secondary source of repayment to a loan. So the good standing of the principals of the company, and generally companies that have owners of 20% or more of the share of the company, we take them as guarantors on the loan for possible secondary payment. So there are a number of avenues that we would look at, kind of determine, first of all, is the business viable in today's environment? Is it a real niche kind of business, or is it a business that will kind of sustain itself through varying economies, et cetera? So,
right. Especially a concern these days, isn't it?
Absolutely.
Yeah. Well, what is the general thought process that a lender has when making a business loan?
Well, again, I think the primary one is, are they profitable? And that seems like a very basic question, but too often many businesses come to the table for an application, and they may not have looked at their plan for the future. We want to make sure that a business that comes to the table for an application has a strong business plan. They've projected a couple of years of revenue, hopefully showing growth. and what possible secondary sources of repayment might be available should the current principal not have the ability to pay the loan. So we want to make sure that possibly, and if it's a startup business, maybe they need to take on an investor. The downside to taking on an investor would be, if I were the investor, I'd want a piece of the company.
Of course.
Some of the startup businesses, first-time entrepreneurs, if you will, maybe hadn't thought about that if they don't have the financial resources to start the business, and having to take on a partner, there may be a reluctance to give up part of their ownership.
Yeah.
But those are some of the challenges that I think small businesses face today. Is what is their plan? Who's running the company? Do they have? We look at is the principal the primary source of the technical resources for running the company? Do they have the overall expertise to run the type of business that they're running currently, and what other plans they might have to sustain their growth going forward with bringing in new technology or additional people to oversee the management of the company?
Okay. Why would a business owner choose to work with a community bank instead of a large bank? Now, I don't know where you place Bank of the West in this. I guess you're sort of a regional bank, but anyway, maybe you can sort of explain a little bit about the roles of these different players.
Well, I think in varying situations, a community bank might be ideal for a small business that is just doing business in a central locale and doesn't need the large bank networking that might be interstate and intrastate. So you have to, the bank needs, the business needs to determine, what is their business need. Are they going to be making deposits locally, which in most communities, the community bank may be accessible there, but if the business has other locations outside of the immediate serving area, then there are some issues with the serviceability of that business. But community banks are a little bit closer to the decision makers on the loan process. Their cost of funds are different than they are with a cost of funds for booking a loan at a large bank. So the spreads come into play. Community banks kind of use the what they call formula lines of credit, where the larger banks have more flexibility to analyze business needs. So depending on the type of business, what their need is for daily or weekly banking, international banking comes into play these days. A lot of community banks don't have that capacity to transact business as quickly as a large commercial bank. So I think all of that comes into play. So the net effect is, I think those are conversations a bank has to have with a customer that comes in looking for a small loan.
Okay. Now, let's say that you're starting a small business and you can't qualify for a loan. What alternatives do people like that have?
Well, I think, as I mentioned earlier, they may need to bring in an additional investor to give support to the debt servicing on the potential loan that is being applied for. Possibly the company or the business owner doesn't have sufficient initial capital if it's a startup business. And again, the downside to that is if you bring an outside investor in for additional support on running the business or as a guarantor on the loan, then they may have to give up a percentage of the ownership in order to kind of make that a viable option.
And I guess in some cases, people, they've come up with creative ways of raising funds. So, for example, of course, some just go to their family members, which of course then the family members need to understand that they may be taking a pretty high risk by going ahead and placing, and then you're taking the risk of things don't work out. Well, then it's hard getting together at Thanksgiving sometimes if somebody's had that kind of a loss. Another is basically like people getting together, if you will, to sort of help each other out. It's happened a lot in the Vietnamese community here in San Jose, where groups of people say, okay, well, we'll get together and help you to get your business started, and then once you get going, then you can help also put some money back into the pool to help others. So have you seen very much of that sort of thing?
Well, I think in today's, especially here in the Silicon Valley, we have such a diverse climate of people that you see more and more of that, where family members and ethnic associations, if you will, kind of rally around people to help support the development of a new business. But I think going forward, as I say, we're getting back to basics in making loans and underwriting. We have to make sure that if monies are coming from other people, are these people going to actually be guarantors on the loan? And we need to check out their credit worthiness as well, because anybody that has a 20% interest or more in a company, we would be looking, generally speaking, for guarantors for secondary repayment facilities. So, and it'll vary from type of loan being requested as well as the amount of loan being requested. But I think probably the bottom line issue in the finance world going forward is banks are going to manage the risk much more closely than we did in the previous few years, which kind of got us to the meltdown in the financial industry here in the last couple of years.
So by the way, the show that we're recording today is January 11th of 2011, to give people a little bit of a frame of reference for where we are. So the meltdown actually happened sort of a couple of years ago, and so we're sort of in the recovery mode now, in general in the economy, although that's what they're saying. It feels to some people like a jobless recovery. It hasn't been very heavy in a job recovery yet. All right, well, what if a person has an idea for a new business? Is that a lost cause?